Get into analyzing stock.
So this is what I want to do. I also want to look at the dividends. I want to look at this one right here. So we have Verizon here. Verizon's the first company we're doing, correct? Everybody knows Verizon.
This is off the Patreon request line from David, our dear friend David.
To calculate how much they're paying in dividends, you look at the market cap, $248 billion. Let's call it 250 just to be safe. 250 billion. Then you come here and look at their dividend yield, 4.19. Let's call it 4%.
Okay.
That is $10 billion a year. That's a big number, guys. So when we do the free cash flow in 0.7 and 8, we want to make sure they have significantly more than they need in order to do this. Now, something that's been very popular lately
Go on.
has been
your shirts. I told you you've been looking really good. In fact, Don, I got home and rewatched some of our videos, and you were looking shredded. You should be very proud.
shredded.
I'm telling you, you look jacked,
shredded,
bro. For a little chest,
nodding his head.
Yeah, for a little chest nerd, you look really good.
Anyways,
go ahead, Paul.
Because remember, one thing that's been very popular lately has been buying shares back. You buy shares back with your free cash flow or with debt. So you want to make sure that they have enough to pay this lovely dividend. That's a very important part. But let's do the 8-pillar analysis.
Okay, pillar number 1 is PE ratio. This is price to earnings, folks. We want this less than 20.
It's 13.57. Historically, it's around 15 or 16. So this is a check mark here.
I like that so far. Okay, how about profit margin? We want this more than 10%, Paul. That's where you want it.
13.8%. Check mark there.
Check it out. Okay.
And the gross margin is 61%. Remember, gross margin is every additional dollar they sell, how much of that goes to the bottom line. That factors in no overhead. It's just the direct cost to generate revenue.
Paul, let's go to revenue growth, which is pillar number 3 over the past 5 years, baby.
All right, this is technically getting a check, but it's not pretty.
Tell me about
131.6 to 131.9. And look in between. Fell to 126, 126, 130, 130. So there's a check mark, but it's not the prettiest. Now, I don't know if there was some acquisitions made here or maybe some dispositions or whatever.
Let's do
net income.
Yep, profit growth.
17.9, 13, 30, 15.5, 19.26. Check mark.
Kind of weird, though.
Speaking of dividends, people are going to say to you, well, Paul, shouldn't I look at the profit for dividends? Sure. Profit and free cash flow over longer periods of time should be very close to each other. I just like to go immediately to the free cash flow statement just to say, let me just see what it looks like here. Because a company could take on debt, and the free cash flow statement will really show you how much money the company is actually bringing in after reinvesting back in themselves. So, according to this, they can support this dividend of $10 billion. So, next one.
Let's look at pillar number 5, which is the number of actual shares outstanding in the world. We want this going down, the shares down.
It's an X, but not by much.
Oh, boy.
4.08 to 4.14 billion shares.
Just
not a ton, but it is going up.
How about current assets greater than current liabilities, which is pillar number 6?
Why don't you explain what that is to people?
Oh, God.
I'll pull it up.
Well, while I explain it poorly, Paul will correct me in about 17 seconds here, but current assets is really their cash on hand, the money they have in the bank, and their liabilities is things they owe. So comparing it to someone like yourself, this is your mortgage, Paul, your car payment.
And what is this, by the way? What is this?
3,400, it's a number.
What does that mean, though?
I don't know.
Subscribers, we just hit.
Oh, wow, Paul.
Right here, like Don's laughing. He knew where I was going with that.
3,400
we just hit 3,400 subscribers on the nose.
We were under 3,000 just yesterday, folks. So we
just
really
yesterday morning, we were
appreciate
under
all you out
3,000.
there. I love you. I love you. I love you. I love you, Paul. Keep going now. Let's do current assets greater than current liabilities.
Cash on hand, $38.5 billion. Current liabilities.
Go on.
Go a little bit lower. $36 billion. So it's an X. So they don't currently have enough cash on hand to pay for their current liabilities. Now, does that mean avoid? No. About 20% of companies deal that way. I don't understand why that is, what their payment structures are, et cetera. Like they might be a very good payment structures as they do that. I just don't like it because to me, it's like I have $10,000 in the bank and I have $12,000 in bills due in the next, short period of time. That's not a very good feeling. But it's not a deal breaker, but it's something to consider.
Paul, this is pillar number 7, which is free cash flow growth, cash from operations minus capital expenditures. What are capital expenditures again, Paul?
Capital expenditures are your investments back in your fixed asset. Now, as I read more, capital expenditures can be split up in 2 ways: maintenance capital expenditures and growth capital expenditures. If they do isolate the two, you should subtract out the growth ones, because maintenance capital expenditures are the capital expenditures they make to maintain the business at where it's at. Growth capital expenditures are, hey, what are we doing to grow the business? We want everybody to be able to do that. So, Seth, are you ready? Well, first off, we'll do 12 billion here, and 17 billion here. So it's definitely a check mark. Now remember, they needed 10 billion. So they have enough money to pay. $7 billion, not bad. I mean, it's not insane, it's not terrible. $7 billion is a pretty good number. So 12 and 17, Seth. And then 4, 7, and 16.
The average free cash flow over the past 5 years is 11.2, Paul.
Okay, 11.2 billion. Now, this is the question we always get. I always want to multiply it by some number. What's that number? I've said 20 in the past. Now, the 20 number isn't set in stone. What you need to look at is, if you think about it, if a company is going to grow fast, should you be willing to pay more money for that company? The answer is yes. If a company has fast revenue growth, fast profit growth, you can justify paying more because it's going to grow into a value. If it's growing very slowly, then you don't want to do that. You remember the revenue here. The revenue is pretty much flat for 5 years. This is a company where I want to pay less, but it's a good brand. This is a subjective number.
This is Verizon. Keep going.
This is a very subjective number. We don't know exactly what number you want to be here. 15, 12, 18. It depends on what you think about the company and its potential. Should there be a discount because it's not growing? Yes. But it's Verizon. What are the chances that Verizon goes under? Would we all be shocked if Verizon was out of business in 5 years? The answer is yes. We'd all be shocked. So should it get a premium for that? At the end of the day, these are things you have to weigh. For Verizon, I'm sitting there saying I want to multiply it by the historical average of 15 times earnings because cash flow and earnings are about the same over long periods of time.
168.
170 billion. What was their market cap? 250
billion.
Yep. So we need a drop of 30% for this to be selling for what it's worth. So now remember.
Oh, go ahead, Paul. I was going to say is, so just to recap, folks, this is Verizon stock. We like the PE, the profit margin. They have revenue and profit growth. Their shares are increasing, not decreasing. Their assets, they can't cover their assets, no pun intended. They have good free cash flow, but their price of free cash flow is still too high.
Now, this is my Excel sheet where I run my models. And I make my assumptions over here. My return that I want, and my profit margin assumptions. 5-year average profit margin is 14.9%. On bigger, mature companies, I tend to keep the profit margin the same. If you want to do a discount for it, by all means. But revenue growth, I definitely do it a little bit different. But this one actually has, according to this, negative revenue growth over the last 20 quarters. But here, the price is 60, and I said 30% discount, make it about 42, and my price is about 45. So if I pay $45 a share for this company, I'm expecting to make about 15% a year for the next 5 years. That's pretty much where we stand right here on Verizon. Now, remember, this is all part of a process. It's the qualitative part of it. It's what makes investing an art. I don't know the exact number. All I know is if Verizon tomorrow was $30, I'd be very excited. I'd be extremely excited if Verizon was $30, right? Let's go see when was the last time Verizon was $30. Probably a long, long time ago.
Jonathan, out here, I'll try and slow Paul down a smidge when it comes to the math. I think the free cash flow gets folks just a smidge. So we'll make sure we slow it down for you guys.
The last time, I mean, it's been since 2012, but look at this company. It has gone nowhere for how long? I mean, it's gone nowhere for 6-7 years, but it's paying a 4% dividend. So I want to buy it at a discount so that I can get some growth out of it. Now, the free cash flow number, what's the part I need to slow down on?
People are just saying, Jonathan just said, can you slow Paul down on the math and break it down a little bit more? We'll work on that for sure. Oh, you're doing great, Paul.
Absolutely. Okay, so that's pretty much where I stand on Verizon. We haven't looked at technicals in a while. So remember, technicals are the 200-day versus the 300-day moving average. If you bought these on a large basket of stocks, you buy when the 200-day moving average goes above the 300-day, and sell when the 200-day goes below the 300-day, you beat the market by about 1.2% over a 20-year period. That's when we back tested it. If you look here, there was a sell signal. The blue line's the 200-day, the orange line's the 300-day. There was a sell signal back here. If you look back here in March of 18, there was a buy signal at about $48 a share, and there was a sell signal at about $58 a share. So you'd have made some money on doing that. And this is over long periods of time. You won't always make money on it, but if you keep consistent and always follow the rules, you can do better than the market. You're gonna have a lot of costs for taxes, but you can do better than the market.